So if you invested in any market in 2020 or 2021, it's highly likely that you benefited from some significant investment returns. We're talking crypto, we're talking stocks, options, Forex, futures, real estate, even the luxury watch market benefited from record appreciation. So if you stay in this investment game for any period of time, you're bound to experience some losses. There's absolutely no way around it. And with the shift with today's economic policy to combat inflation, risk assets are not doing so well. So in today's video, what we're gonna specifically look at is how to combat your investment losses. Let's get it. What's going on, everybody? Brian Rivera, CPA, and on this channel, I typically talk about personal finance, entrepreneurship, and investing. So if you are brand new, don't forget to hit that subscribe button. All right, so when we talk about losses, sometimes the loss is right smack in your face. Maybe you bought a stock at a certain price and it immediately dropped and you feel the pain right away. Other times it's subtle, where it's a slow and painful bleed over time, where you're just slowly seeing your investment do this. Now, losses in the markets come in many different forms, and the losses can be painful, but if you have the right mindset and you have the right plan of action, you can mitigate these losses. So probably the simplest loss to comprehend when we talk about investment losses is a capital loss. And usually this happens when you buy a capital asset and you turn around and sell it for less than what you bought it for. Now, how you leverage a capital loss is capital losses are offset against capital income. So you have to have capital income for you to absorb your capital losses. So what's cool is you can maybe take a loss in one investment market, but have a gain in another market where the loss and the gain will now absorb against each other. Now, there's two classifications of these capital losses, and it's all based on your holding period. So if you're a day trader, or if you're somebody who is flipping stocks in and out, typically this is gonna be a short-term capital loss, which is anything you held less than 12 months. And if you're a long-term investor, it means you've held that asset longer than 12 months. Usually this is going to be classified as a long-term capital loss. So when you look at the tax rules, you first must offset your short-term capital losses against short-term capital income. You then apply that against long-term capital income. Now, another type of loss that you won't find in any textbooks is opportunity loss. Now, let's just say you have an investment, maybe you're in a high growth stock or you're in something that everybody wants to be in. Let's say you put 10 grand into something. You know, you have your ups and downs throughout the year, but then at the end of the year, you're happy because you're break even, but you didn't actually lose money. But there is an opportunity cost with you holding that particular asset for a long period of time. So you may be quick to tell yourself, hey, well, at least I didn't lose anything. That's not necessarily true, is because that $10,000 could have been put to work in another asset, causing you to, quote unquote, not have a return for your money. The whole purpose of investing is to reap a return on your investment. So you've generally experienced an opportunity loss when your investment goes absolutely nowhere. You compare that against bonds, CDs, or even interest rates that you get from your local bank. If those are beating your returns, then you have experienced what's called an opportunity loss. Another type of loss is called the missed profit losses. Now, this type of loss is, I see people who are short-term day traders experience these a lot more than those that are long-term investors. So missed profit losses usually happens in a very volatile investment. So a lot of times people try to time the bottoms and tops of particular markets. And so if you are in an investment that you see run up and then it has a pullback, well, in your mind, you're already calculating how much you lost out on is because you did not actually sell at the top. Not many people are successful or have a good track record of calling the tops or the bottoms, is because it's very hard to be right at a point in time. So as a day trader, you're capitalizing on risk. You are risking X to make Y, and you're also just trading along the trend. So you're not really trying to nail the bottom and nail the top, because it's pretty hard to do. However, you can make educated guesses at capitalizing on volatility at a moment in time. So the best cure for this type of loss, have an exit strategy before you even enter that investment. Know in your mind that if it does this or that, this is when I'm going to pull the plug, and you don't worry about what happens later on. Now, the fourth type of loss I'm going to discuss is paper losses. A lot of times you'll hear people on social media and online say that, well, if I didn't sell, technically I didn't lose. While it's only a loss on paper, you really need to figure out what you want to do if you're position has taken a major hit. I'll never forget when I saw the meme stock rage, where everybody was buying GameStop, AMC, you know, Blockbuster, Bed Bath & Beyond, a lot of these different companies that were having some extreme run-ups. Well, if you were the guy that bought at the top, you could be down 80–90%. So although you didn't sell your position, you do have a massive unrealized loss that you need to figure out what to do with it. So if you're an astute investor, it may be a good idea to add to your position if you do feel like long-term that position is going to materialize. However, if you are wrong, then you're going to be in that missed opportunity bucket, because you are going to be dumping money into a position that is never going to materialize when that money could have been put to use in another market or in another asset. Fact of the matter is, no one wants to suffer losses. So the best move that you can make is to cut your loss and move on to the next trade. Nothing wrong with saying I was wrong and moving on. Turn these losses or mistakes into learning experiences so that way you can move forward. Sometimes they say in investing, the best tuition is market tuition. If you lose money enough times, you will then be able to calibrate your decision making so that way you won't repeat those mistakes again. Analyze your choices and don't let these losses define you. It's only one trade, and thankfully you'll have enough capital to move on and trade again. Now, lastly, if you are in that realized loss bucket, just remember that if you are an investor, these are considered capital losses. Capital losses are only offset against capital income. If there's no capital income present on your tax return, you get to recognize $3,000 against other income, and you're gonna carry the loss into the next tax year, and we're just looking to make sure you got some capital income. If there's no capital income, you'll continue to recognize $3,000 per year until A, the loss is completely used, or B, you have capital income present that's gonna offset that capital loss, so that way you can now move forward. Now, I know a lot of people are active day traders. A lot of my audience are active day traders. One of the things that you have at your toolkit is something called day trader status. So if you qualify as a day trader, guess what? You have the ability to elect what's called mark-to-market accounting. And if you are a mark-to-market trader, guess what? Your losses are recognized in full. And so you don't have to worry about capital loss carryovers, is because you're gonna recognize all of your losses in that current year against other income. And a lot of times, if you've already paid taxes on your other income, then you can get a refund back from the IRS for any taxes that you may have paid during that year. All right, family, I know a lot of people don't like discussing losses. We only wanna talk about our wins. However, I feel like because there's so many different monetary changes, the market dynamics are changing, crypto's getting smoked, stocks are getting smoked, I figured it would be a good time to level set and talk about losses and what you can do with those. So if you're looking for more information on tax-free wealth strategies, different tax strategies that can help you save up to $30,000 per year, I'm currently running a free webinar where we're gonna teach you 3 different strategies to save at least $30,000 or more on your taxes. Don't forget to hit that like and subscribe button. We'll catch you at the next one.